Hello, everybody. So I try to limit my coverage of HIMS to once a week. But, today there was some good news. Actually, over the weekend, HIMS is joining the S&P 600. And the volatility of this stock is nothing short of amazing. If you take into account that 3 days ago on Thursday, it was fear, 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 a drug that HIMS does not sell, came off shortage, and so came off a shortage list, and so the stock went down, traded all the way down to $16. And today, not even 3 trading days later, the stock is up 20% compared to that level, and it actually peaked at about $20 at $19.96 today. Who knows where it will end the day? Maybe above $20. The volatility in a matter of 3 trading days is pretty crazy with just 20%, just like that. And why are they up? Of course, because they're joining the S&P Small Cap 600. And the irony is not lost on me that they are replacing the maker of an inexpensive cigarette brand. So that's very interesting that they're replacing a cigarette maker. A health company is replacing a cigarette maker. I love it. I think it's great. Anyways, so what are the key benefits of the inclusion of the S&P 600? Well, of course, the benefits are I'm going to hopefully have to make less of these videos trying to teach analysts how to look on Google because, you had articles 3 days ago saying that HIMS was going to be hurt directly by the end of a shortage of a drug it does not sell. And so I had made this article where I show how to do a Google search, and they don't sell that, right? And it's like the stock dropped because of this volatility and the fear, uncertainty, and doubt. And all it takes is one person to write one article for 50 news outlets to write the same article. So the key benefit of inclusion in the S&P 500 is that maybe the market is finally going to realize that HIMS does not sell tirzepatide, and so whenever there's news about Lilly, maybe the stock's going to stop moving. But of course, I'm being facetious here. I'm joking. There's other advantages. One of them is you're going to have more analysts, and so the predictions over the long term, they should get more accurate. The revenue growth predictions should get more accurate. More analysts should figure out what HIMS does and what they sell and they don't sell. Of course, the perpetual bid. So this is important to have this constant inflow of new buyers every month, every 2 weeks. Many people just dollar cost average into index fund, and when they dollar cost average into small cap index funds, well, they likely buy the S&P 600 or a variation of that. And so that perpetual bid means it's going to be easier for HIMS to perhaps raise more money if they want to do at the market offering, but they're also going to have a little bit lower of volatility. Being in the S&P 600 means you may have more institutional investors. You may have also better credit ratings, assuming they wanted to borrow money someday. And of course, credit ratings are just more than borrowing money. Sometimes some funds can't buy the stock if you don't have the right credit rating. And I also think they could get more liquidity on things like options if you're into that for a stock like HIMS. I myself have a few long-term leaps on HIMS. Liquidity is low. That liquidity could increase on HIMS. And of course, the downside of all of these benefits, well, the stock price is more expensive. That is the downside. And that's a downside, I guess, only if you don't have a full position. In my case, I am done with my position of HIMS. It's a full position, and I don't anticipate to be adding. I'll just keep writing it because it is a full position. I've been following this stock for more than 2 years, so to me, not much of a downside. But if you're still building this position, this is no good news. Make no mistake. If someone is still building their position, no investment advice, no good news, because the S&P 500 means perpetual bid, means lower volatility, and of course, this is all very theoretical. And quick scale news here. How much money are in these ETFs, right? That are indexed on these small cap index S&P 600. How much money is there? Well, there's really one that is huge, which is the IGR from BlackRock's iShares, and it's $74 billion. it's more of asset under management for that fund. So it's quite a bit. All of the other funds are much smaller, right? The Spider one is 4 billion, the Vanguard is 2.5 billion, and this is what I was saying on my Patreon the other day, which is, yeah, unfortunately, small cap ETFs, they're not as popular as they once were, and so make no mistake, in my view. And this is a stock I want to hold for the long run. In my view, the big deal will be if and when they join the S&P 500, they will start showing GAAP profitability. You need 4 quarters of GAAP profitability, and you need market cap requirements. For market cap right now, for them to be eligible for S&P 500, they would need to do a 8 or a 9x, right? And so, and of course, by the time they do that, really, the minimum market cap for the S&P 500 inclusion will be much higher than $30-ish billion. It might be $60-ish billion. So maybe we need to do a 16x, 17x before they get included into the S&P 500. Not a problem for me. I'm in this for the long run. This is a company that is growing very, very fast, growing its sales at 50% a year with no sign of a slowdown, plenty of new drugs that they may be offering, plenty of new RX, new prescriptions. I believe they are part of this key story of disrupting pharmacies and disrupting a lot of mom and pop doctors' offices being replaced by this app. That's kind of where my thesis is. Mom and pop doctors versus the app. The app is winning. HIMSS, of course, focuses on low stakes, smaller health issues, not the big things. I don't think they are going to disrupt the big issues, but the small issues, I think they are very compelling and they will disrupt. So how cheap is HIMSS after today's pop? Well, guess what? It's still the second cheapest. When you have this margin, it's still the second cheapest. So in my spreadsheet, I have more than 120 stocks, and actually one of the complaints, and if you saw the updated spreadsheet, I'm at the top 10 cheapest here, right? Half of those are Chinese, but it's not lost on me that the top 2 are not Chinese. They're online prescriptions companies, LifeMD and HIMSS. These 2 are cheapest than even all of the Chinese stocks I have on there. And so HIMSS is still the second cheapest. LifeMD is cheaper. But as I've noted in my last video on LifeMD, I do think that the total addressable market for HIMSS is much bigger because LifeMD partners with physical pharmacies for prescriptions. HIMSS does not. HIMSS has its own automated pharmacies that fulfill, but that's a minor distinction. I think HIMSS is for all intents and purposes of this channel and for the size, for a company of its size of $4 billion, which some people would never touch a micro cap like LifeMD. So for a $4 billion range, for that type of valuation, it is the cheapest, and it has been the cheapest for 2 years, despite the stock more than 3xing since I started covering it. It is still the cheapest. Make no mistake, the stock is trading at 2.5 times forward sales. Analysts are saying it's going to grow at 53%, but if you follow this company, if you know the guidance, they commonly beat that guidance, and the number might actually be higher than a 53% sales growth next 12 months. This is a company whose operating leverage has kicked in. If you follow HIMSS closely, they are guiding for 25% EBITDA margin within the next couple of years. So that EBITDA margin is gonna pop. And this company, of course, has 95% of its revenue being recurring revenue because they focus on these minor health issues, small health ailments that require a permanent treatment, or at least a treatment that takes years. And so these drugs are recurring prescription drugs. And so that's why 95% of business is recurring revenue. If you're wondering the last 5%, that's because they have a little bit of a shampoo line, and their shampoo, and they have condom line and stuff like that. That's not recurring. But otherwise, 95% is recurring. And of course, the analogy is not lost on me. HIMSS is still the disruptor, right? HIMSS is still the disruptor of pharmacy. They're still dealing with online prescriptions. If you look at SaaS businesses, which HIMSS reminds me a lot of a SaaS business, mostly recurring revenue, you sell more as a cohort stays with the HIMSS app, you sell more, right? Somebody may get onboarded with HIMSS for ED issues, but then the human body being the human body, you find out that ED issues are highly correlated with also hair loss. And so customer in year 1 signs up for ED issues, and then in year 3, maybe the customer adds hair loss, and maybe in year 7, the customer adds a GLP-1, right? It's correlated. A lot of these correlate. So same as a SaaS business. A SaaS business is you might sign up for one product, and then year 3, you add another product, year 5, another product. Recurring businesses revenue. Recurring business revenue is what HIMS is, just like a lot of these SaaS companies. But look at these SaaS companies, look at valuation: 13 times sales, 8 times sales, 11 times sales, 15 times sales. All right. So just from that valuation standpoint, this sector is just totally ignored, entirely unappealing. I think a lot of that has to do with still the fact that HIMS used to be a SPAC, and the market thinks SPAC equals bad, and it's not able to distinguish which SPAC was good and which SPAC was bad. And just like it's not being able to distinguish GLP-1s and all of the GLP-1s out there, and which one a company has listed on the website and which one a company does not have listed on the website. That's what happened 3 days ago, right? HIMS does not sell all of the GLP-1s. It only sells certain kinds, and that was not the Lilly news, and the stock dropped even though it doesn't sell that. So hopefully these analysts are going to bring a little more sanity into this stock and into these news articles, and they're going to be more accurate. Hopefully, it's a good news if you have a full position. If you're still building a position, I still think it's a good news too, because the volatility will still be there, in my view, at least for the next year. It takes time for this perpetual bid to kick in, for the company to move up also within the S&P 600 ranking. And maybe I'll see you in 2 years or 3 years from now when they get moved to the mid-cap index, right? And we will see how that goes. So this was not investment advice. This is no financial advice, just entertainment. Hoping you were entertained. Please like, please subscribe, follow me on X. If you want to have access to all of my premium content, my spreadsheets, everything I do, you can take a look at Patreon. Thank you for watching. No financial advice. Have a wonderful day.